Welcome to On Track, and this is our February 2020 edition. The numbers I'm going to show you for the end of January, but I will start by apologising for being about a week late on this, and it's purely because, as I was about to record the other one, markets started to move a bit around the coronavirus thing, and I'll talk about what's happened there and my thoughts around that. But my apologies, I thought it would be better to be relevant rather than have it come out while markets were sort of falling. But let me get into it. As always, this recording is designed for clients of McGregor Wealth Management who are long-term investors. For those of you that aren't getting advice from us, this is general advice only and may not be suitable to your circumstances. So as usual, I'm going to cover the important economic news, and the thing that's dominated certainly the last month is coronavirus and the impact there. I'm going to put it into context, which is really important. In other words, does this matter for my long-term wealth? I'll give you an update on the key markets and put it all into perspective. So let's have a look at the news highlights. And we're ticking along in Australia, and everything's just okay. We're not hot, we're not cold. Profit numbers coming out from companies are okay. They're not booming, they're not terrible. They're okay. We've got growth slightly there, 1.8%. Cash rate low. I suspect we might get a cash rate drop in the next month as a response to the coronavirus, which I'll talk about more. And it's not so much the coronavirus, it's the fact that economic activity will have slowed a little around the world. Not a lot, but a little, and that means governments are going to want to help move economy along. Australia's still growing okay, and like I said, everything okay, not hot, not cold, just in that middle, just slightly below the averages, but not too bad. Internationally, last month we talked about US around trade tensions. They seem to have gone for now, but that's been on again and off again for pretty much the last 50 years. The one that's dominated is the coronavirus, and I'll talk about that in detail. That'll be my topic this month. We're seeing the start of the Democrats' presidential nomination race, and with Bernie Sanders leading that, which is interesting. We're seeing the rise of extremism. So while we've got an extreme right president in Trump, it looks like we might get an extreme left Democrat challenger, although there's still a long way to go there. And we'll see what happens there. The US Fed has also kept its rates on hold, and the US is actually in reasonably good economic shape on most of the numbers. They do carry high debt, but on everything else, they're just ticking away nicely. And it's just a repeat of that continuing theme, which we're in low to moderate growth, we're in low inflation, low wages growth, we're not in any sort of boom, low interest rates, and the share markets most of the time are climbing that wall of worry and occasionally coming back, as we've seen this week. Just a reminder, the four pillars of what we do. It's all the modern portfolio theory is just the portfolio design that we do, but the biggest risk to all of our investors and every investor is making bad decisions at wrong times that are normally reactive to media and news, etc., because you don't have confidence in your investments and your strategies. So the care process that we use hopefully helps to give you confidence in things during times like this. Here's that long-term perspective again, and the way we frame the market. The market does go through those three broad stages: the boom or the FOMO, the bust or the fear, and then the wall of worry. And when you look back at the last, what have we got there? The last sort of 30 years just about, you can see that most of the time the market's in a wall of worry. Occasionally it has a boom, and then we're quite clearly in the wall of worry at the moment. You can tell that because we're worried about stuff. When we get into those booms, we tend to stop worrying and start to write a new story. Not there yet. These are some of the ways that people mess it up. My focus in this month is going to be on the bit on the media, a bit on the motions, a bit on the short-term and single issue focus, once again, which is coronavirus. So let me talk first about the psychology around bad news. And markets don't always behave the way people think they should behave. But the market, let's say it's just going up, and up is its natural direction, because around the world we have rising prosperity through economic growth increasing, population growth increasing. So up is the norm. But every now and then some bad news comes out. So when it's unexpected bad news, that causes the market to drop. Now, if we get more bad news, and here's the distinction, that is worse, the market will drop again. Not always by as much, but the market starts to go down. Now, eventually, we can still be getting bad news, but if the news is less bad, the market starts to go up. And this is the thing that people don't always get. Often they'll want to wait to see what happens till the bad news stops. But generally, it's too late, because as the news gets less bad, markets recover, and eventually the crisis is over and we're back above. So the real danger zone is the panic zone, is when the news is getting worse and people start to say, I better get out and wait and see what happens. So what happens in those situations is the news eventually gets less bad, but it's still bad. So markets rebound a bit, it gets less bad, but still bad. And markets have pretty much recovered. And then by the time the news is sort of, or the crisis is over, we're above where we started. So people that panic and get out get massively, they lose money in those times compared to the people that just held on because they can and because they're better educated, better informed, better advised, and that's what we're seeing at the moment. So the key messages around anything, and I'll put this in perspective further in the next few slides, but it's always, don't panic. The news always gets better eventually. It just always does. Single issue crisis like these ones have never caused a sustained market crashes, and they're ones that are more than 20%. It will absolutely potentially contribute to the 5, 10, 15 percenters, but it's never caused the big ones. The big ones have always been caused by irrational exuberance on the upside, and then we get a crash to recover and bring it back to normal. So let's have a look in at some of the data around this. And I believe that the news is getting less bad. And we originally saw the market, the chart on the right, and I'll get my cursor there. So we dropped, this was the cycle in sort of as coronavirus news came out, the market dropped, it dropped again, then the news started getting less bad. The number of confirmed cases was dropping, even though the headlines in the mainstream media continued to look worse. People that were looking at the real data said, well, it's not as bad as it might be. And the market actually came back strongly. But then we've got some more news, and that news is that maybe they weren't counting properly, and there's a bit of a breakout around the world, in other places. This is still tiny, and I'll put it in perspective in a minute. But you can see here this red chart at the bottom. The daily new cases, once again, is declining. So the news will eventually get less bad, and this will come up. The markets are down between sort of 7 and 10%, depending on where we're measuring. But we're definitely in that bad news cycle. Just to put in perspective, influenza, coronavirus is another type of flu. It's a new one, a novel virus. So the fear is that people don't know how bad it's going to be and how bad it gets. But the regular flu, just to put in perspective, in the USA alone, in 2017-18, a regular flu killed 61,000 Americans. So that's just America. That's not worldwide. So the number of deaths from coronavirus isn't even remotely anywhere near that. It's still in the low numbers relative to these other things. So you can see here, 10,000 to 60,000 is sort of the amount of deaths in the US every year. So one perspective. And just another perspective, I mean, the motor vehicle virus, if I want to call it that, motor vehicles cause $1.35 million death. 1.35 million, not dollars, deaths in 2016. It's about 1 to 1.5 million people every year by the motor vehicle. Now, we don't not get in our cars. We take protective measures, etc. And eventually all these pandemics are seen the same way. In fact, if we look at the pandemics in the last 40 years, none of them have had a major impact on the market over 6 months or 12 months. The only one that's reasonably high there is the AIDS epidemic that started in 1981. Now that downturn wasn't actually caused by that. There was other economic events going on. But you can see for all the rest of these pandemics, so we've got SARS, bird flu, dengue fever, swine flu, cholera, all the things that we forget, the market still did absolutely fine over those periods. In fact, what comes through eventually is we're back to economic growth, and company profitability will take over once we start worrying. But we're definitely worrying at the moment. So you'll see that in the numbers. Now these numbers, for the next few slides, the charts show to the end of January, but I've updated down the bottom, and apologies once again for being late. this month, but it's because I decided to update everything rather than send out stuff that was a little bit out of date, because I wanted to deal with the coronavirus head on. So you'll see up the top, to the end of January, we were high. We had gone down and then recovered fully, but you'll see in the bottom right-hand corner that dive now. But have a look how far back it goes. It only goes back, we've only gone back to levels that are about literally a month ago. So just prior to Christmas, we're at the same level we're at now. And that's pretty much all the markets. So in this little downturn, 7 to 10%, all we've done is give up profits that take us back to about Christmas. So not too bad at all. And it was actually much needed. We were saying the Aussie market was a little expensive at where it was, at just over 7,000. Nothing to panic about or do anything about, just expensive. But we're now saying it brings it back into fair value range, which for us is around 6.6 for the ASX 200 to 6.7. So we're now back in that range, and we're quite comfortable with people buying at these levels. US shares the same. They were sitting at their record highs. So we were at 31% for the year. So a 10% correction was overdue. We've come back 10% as I record this, quite healthy. And that's put us back into fair value range as well. So it was getting a little expensive, but now back to fair value. US small caps, they'd had some corrections back in the end of 19. They came down a good nearly 30%. So it's been back to fair value for a while since then. It was getting a little fair to expensive, not quite expensive. We now think it's absolutely fair value. So it's also come back about 10% from the highs of January. Global leaders, that's the top 100 companies in the world that sits in our active portfolio for most of our clients. And this is the Facebooks, the Googles, the big companies around the world that are doing so well at the moment. But they've been doing so well that once again, so 33% for the last year, so quite spectacular returns. But eventually you're going to have a little bit of a correction. And sometimes something like the coronavirus will be the trigger for that. But it's really just the market taking a break. As I scan the headlines this morning, and it's the 28th of Feb as I record this, there's headlines starting to appear that looks like buyers will be coming back into the market. And certainly that's the case for us, where we've had money on the sidelines with people averaging in, where we're starting to say, let's get some more of that in, because these it's reasonable value at where it is at the moment. Emerging markets they'd been the worst performer over the last year. So even to the end of January was only up, and only 9%. Now 9% is pretty good in a world where interest rates are 1 to 1.5, but they've come back a bit. Ironically, they haven't come back by as much because they were already cheap. So we haven't seen the same correction in emerging markets, even though these are the countries that are probably more impacted by coronavirus. But once again, back in perspective, there's not a big impact here. Now, let me put this into context. For those that get sick, and obviously those that die, this is a big thing. And there's people that will get that, and that's obviously not good for them. But in the broader context, it's less than, as I said, normal flu, and less than other things that are dangerous to us, like motor vehicles. The bigger issue for the markets, and the thing that we worry about more than the health impact, even though that's a real human impact, is economic impact. And we know from colleagues, etc., that China is in a bit of a slowdown, or their growth is slowing a bit because people aren't getting out and about. But I would point out that we tend to substitute. We're all still spending the same amount of money. So people that were going to be going to Asia for holidays might now be going to Noosa or Port Douglas, or back to one of our bushfire zones to help our economy. So we're still spending the same amount of money. We just spend it in different places. So there are winners and there are losers from that. Now, because we're not individual share pickers, because we're predominantly index investors, we pick up the winners and the losers. For people that have really refined share portfolios, at the moment they're trying to work out what impact this has on their companies. So they have to, and you can't tell, by the way. So, and all of a sudden, when you can't tell on the news is negative, you're more likely to make bad decisions. But we think emerging markets are quite cheap and very comfortable owning them. Look at gold. Everything else down. Now, gold was up 29% for the year, and since this coronavirus outbreak in February, it's up another 10%. So it's absolutely flying. It sits in the active portfolios. So it's like an insurance policy. And it's an important part of your portfolios for these exact reasons. So it gives us a little bit of a buffer when markets do their correction. But overall, we're very comfortable with the markets. For those averaging in, it's a good time to bring forward one or two. And if it gets much lower, if the market was below 6.5 in the ASX 200 terms, we'd be comfortable with everyone putting all their money in pretty much, subject to them being comfortable with that. So performances, and these numbers are to the end of January, so they will have come back a little bit, but they were quite spectacular over a year with the high growth up above 20%. So once again, in territory where a correction at some stage this year was inevitable, what's never certain is when and how, and what would prick it and how much. But it's been the coronavirus to bring that back 10%. It may go further. No one can tell you, not me, not anyone, whether it goes further. But I get a feeling that there's buying activity going to emerge. And the only thing that will take it further is news that's to use bad English, more bad, not less bad. So if the news got worse, so more of the same bad news will not make the markets go down. It's only news that is worse than has been coming out. And as soon as it's less bad, we may see the markets rebound quite strongly. So waiting to see what happens is rarely ever a good investment strategy. Over to property, and there's not much red left on the board here. So it's nearly all green around Australia. And we've got houses and units here, and we've got the changes over 1 month and a year. Perth still on the negative. We don't mind Perth as a good place to invest for property, but it hasn't sort of had the catch up. Darwin's been quite sick, and no signs of it emerging. In fact, when we look at our Heron Todd White, Darwin sits at the bottom of the clock there, but it's nothing happening. This is a model, so it's not the gospel, and they get it right, and sometimes cycles are really quick. Sydney went from the peak of the market right down to the bottom and is back rising and recovering, as is Melbourne, and it's been quite remarkable actually, the quick recovery of Sydney and Melbourne. And those cities are driven, the property markets are driven by population growth and economic growth. And both of those things are likely to continue. Unit market the same. In fact, Heron Todd White didn't change any of the status of any of these things, and you can patiently look over this in the printouts. So to put it in perspective, as always, it's steady as she goes. It's stick with the plan. It's actually become a better time to be buying. It's still a reasonable time to be selling. Anyone who's all in share markets is still up 18 to 20% from this time a year ago. So still quite remarkable. There may be better times to buy or sell, as always. The key one for us is for anyone who's coming through at the moment with new money, whether that's from something they've sold, whether that's from inheritance, or whether it's from just retiring. We're putting that money in, we're spreading some of that over 12 months, but when we get corrections like this, we're happy to bring some of those forward. And yeah, definitely happy for that at the moment. Market, as I speak, is about 6.6, bang on what we call fair value, so very comfortable with money being in. If it got to 6.5 or 6.4, we'd call it cheap, and we'd be encouraging people to get everything in that should be in the market, because all we're ever trying to do when we average in is minimise risk. For our dollar cost averages, our people still working, this volatility is awesome. It means you're buying this month's shares on special, so bring on more volatility in some ways. And as always, we do the rebalancing based around where these markets are at, but continue to review as always. So just to finish up with reinforcing the process, it's always about your goals and how the portfolio needs to be designed to meet those long-term goals. From there, we do take a long-term view. We're very interested in what's going on, and that's why we do these videos, because it helps just fine-tune the investments, but more importantly, it helps avoid our clients making mistakes and being reactive to news, which most people. The biggest protection you have is diversification, having a good asset allocation, and having enough liquidity to get through any of these short-term crises. And as I said, for our clients still working, it's averaging in over time. Apologies, too quick there. So yeah, I'm very conscious as I record this that who knows what's going to happen. I'm recording this with market down 10%. My base case is we've probably got a 70 to 80% chance that this time next month the market will have recovered. There's still always a 10 to 20% chance the news gets worse or other bad news emerges, which might push it down a bit. But any downs from here starts to get into the really cheap territory. And for people that analyse the world as it is, not through the eyes of the media, that represents good buying time. And as money comes into the market there, that will eventually turn it around. And the market will resume its normal, and it is normal, upwards cycle. That's it for the month. I hope you have a great month. I hope good things are happening in your life, and look forward to catching up and talking to you soon. Rob McGregor, signing out.